Hi, everyone. Welcome to the Canadian Passive Investing Show. I'm your host, 𝗖𝗽𝗶 𝗖𝗽, and I'm joined by my co-host, August Biniaz. We have another really exciting, incredible show for you today. So please like and subscribe as it helps us build our channel and allows us to keep bringing you great content and incredible guest speakers. Now, our mission here, you guys, is to empower investors to earn passive income through real estate investing. We're really excited because today we are joined by James
Kandasamy.
Kandasamy, absolutely. That's perfect.
Kandasamy, perfect.
Just say it as it is.
Perfect, Kandasamy. Now,
Yes.
a little bit about James. Since establishing Achieve Investment Group LLC in 2015, James has syndicated 9 large apartment complexes totaling 1,700 units and has grown his portfolio to over $130 million. Okay, James is also the author of a book that August and I really love. It's called Investing in Commercial Real Estate. And he's also a regular speaker on many real estate platforms across the US. So we believe this interview with James will bring great value to passive investors looking to start investing in real estate private equity. And also James is going to bring an immense amount of value to our audience because he literally wrote the book on passive investing. So thank you so much for being here, James. Welcome.
Absolutely, absolutely. Happy to be here, and good that all of you are adding value to the community, because I see a lot of you guys posting a lot of content on investing in general. So happy for that.
Awesome, James. Why don't we dive right into things? And if you could just please start off by telling us about your background and your start in real estate, please.
Sure, absolutely. So James Kandasamy, I'm a former electrical engineer. Still love electrical engineering. It's a lot of fun. And I also have an MBA, and originally from Malaysia, studied in Australia for my MBA. So I'm very familiar with I used to have a Canadian PR. I almost got. I got approved for the Canadian PR, but I didn't really pursue it because I came to the US, right? So, yeah. We are based out of Austin, Texas, and we actually own like 13 apartment complexes right now. So I need to update whatever resume I gave it to you.
Yes.
Almost 270 million in assets right now, plus another 100 million in ground-up construction that we're doing. So it's almost like 300 to 400 million in assets under management. And one special thing about us, when we throw in all these big numbers, millions and all asset under management, people talk about billions, and this is all we own ourselves, right? So a lot of syndicators out there, they own like 10 people, or they own 0.01% of 500 units, and they add that 500 units into their portfolio, and they make it big, right? So for me, I like to make it very simple because I'm a numbers guy. This is where we are the only GP, right? So with our investors, but we are the only GP. We raise money ourselves, we asset manage, and we also do property management ourselves. So completely vertically integrated, right? So we control the A to Z of the whole investment business.
Awesome.
And as I said, we are doing ground up construction right now. We have like 600 units right now. Actually, we have like 700 units right now under construction. And have been doing this for past 7 years.
Yes, and maybe talk to us about your start. Did you start with investing in single family like many operators and sponsors started out? What was your journey like when that kind of transition? And why did you start focusing on multifamily? What was it particularly about multifamily that interested you?
Yeah, absolutely. We started with single family. I would call it rentals. We started with rentals, buying low and remodeling it, and then refinancing it, and so renting it, right? So it's called the 𝗼𝗜 method. That's what we did in a single family. We had like 13 single family houses. Once we go to the 11, it becomes very difficult to scale more, right? Because here in the US, we have Fannie Mae, and they have like this 10 house limit per person, and after that you have to do all kind of tricks to go beyond that, right? You have to go and do a portfolio loan and all kind of tricks. So I said, okay, this is too much work for a single family house. You have to manage the insurance, you have to manage taxes, you have to manage different renters and all that. So we looked at multifamily, and that's where we started jumping to multifamily, because multifamily is all in one location, is a business by itself, and also it focused a lot on NOI, right? So when I was doing my single family, it was very interesting. I'm a very analytical person. I was like, calculate, why do I need to go to multifamily? The numbers doesn't show it. So I was calculating my single family. I own the entire house myself. I make like what 9 to 12% cash on cash, and sometimes can be infinite, right? Because we refinance and pull out our equity out. So why do I need to go to this multifamily? So I was trying to do this calculation all the time, and it clicked to me like after 2 days, because I like to show by numbers. I said, why people need to go to multifamily? I have to go and syndicate with other people. I have to share with other people. It's a bigger deal and all that, right? So, and I realized one thing in multifamily is is something called a deep value add, right? Where you can increase the NOI and you can pull out all your money or a lot of your money, which means you can recycle this big amount of capital that you have on a multifamily if you buy it right, and if you're able to refinance and take it out. So you can build a lot of apartment complexes with very, very low down payment. Same thing like what I did in single family, but in multifamily is a lot more powerful because you can use your skill in business to increase your income, reduce your expense. You push up your rent, push up your NOI, and you're able to go and refinance. So we did that on a few deals, and that was the reason why we jumped into multifamily, because multifamily is focused on NOI, right? So so that makes a whole difference of why we're gonna go to multifamily.
Awesome.
The power of multifamily and that NOI and increasing it and creating lots of value.
Exactly.
Yeah. Especially when you do deep value adds, because that's
Yeah.
what we specialize in. We like to buy deals which has a lot of upside, and then we like to put our sweat equity, and we have to be able to refinance and take it out the money that we can.
Nice. I love that. Very, very powerful. Now, for those of you who are listening, James is the author, as this book, as we were mentioning, and has insider secrets to achieving financial independence. But James, we wanted to ask you, like, how did this book all come about, and what motivated you to write the book? If you can
Yeah,
answer that, please.
I would be happy to answer that. So I had on my first deal, my 45 units, I was so proud of myself because I found this deal off market. I had a really good plan, and I was able to raise the money. It was only 450,000 on my first deal. I was able to raise the money within a few hours, right? I have a following that were looking for deals from me. And I bought this deal, and then I had an investor who had like $1 million with him. He started investing. Right. He said, I'm going to put 100,000 with you because I love the deal. This awesome deal and all that. Right. So, and after 6 months to 1 year, I brought him another deal to him. I mean, we are doing very well on my first deal right now. Right. He knows the perfect deal. And I went back to him. Hey, I say, I'm going to invest in this. Yeah, I know. I had $1 million, but I only have like 50,000 right now. I said, okay, he's going to invest 50,000. Right. So then I asked him, hey, what happened to the rest of the money? Oh, I see. I put the money everywhere to all the other deals.
Diversify.
Right. So yeah, he diversified. Then I asked him, hey, what's so special about these other deals? No, he said, well, I don't know. I mean, all deals shows good returns, right? So that's where I realized, people really don't understand how does real estate investment works, because for a newbie, they think every deal is the same, right? For a person who got introduced into this cash flow concept, appreciation multifamily for the first time, most passive investors will think that, all the deals are the same. Let's go and quickly make all my money work, right? They have $1 million. Within 6 months, they'll distribute across 10 investment, and they said, I diversified and I'm happy. I want to move on, right? I'm sure you guys are having that experience where people like to diversify all their money, right? But fast forward 3 years later, that same investor came to me, James, I realized that your deal is so special compared to all the other 9 deals, right? And then he told me another one more deal. He said, your deal and this other person's deal is really special compared to other deals. If I have known that fact on how to analyze deals in the beginning, I would have chosen just 2 of you guys and just focus on 2 you guys, right? So it's concept between diversification versus focus, right? I know we talked about diversify, let's diversify. It's true, you're going to diversify. But I also realized that a lot of people doesn't know how does this private syndication works. How to analyze a deal, how to choose a deal sponsor, right? Then I realized, okay, I need to educate people, because if I don't educate people, first is people are just going to think that everything is the same, right? And they're going to realize it after 2-3 years, right? They're going to realize after 2-3 years, and it's going to be too late at that point of time, right? As I said, it can be very interesting for a lot of people when they first found that out and they start throwing money into these kind of deals very quickly. Yeah. Right. But only after 3 years, they realize, oh, actually, it's not the same. right?
And I was going to
Does
say,
that make sense?
it makes sense.
Absolutely,
And I was
yes.
going to actually say, maybe you can share some golden nuggets
Mhm.
with us. And maybe you possibly have it in your book, but what are some golden nuggets that passive investors need to know so that they can become successful passive real estate investors?
Yeah, absolutely, absolutely. So some of the things I wrote in the book, and my discussion, just this is fresh out of my mind because last week I talked to a doctor investor who just started in 2020. Right, this doctor said, "Hey, I had $1 million. Same thing, the same thing. Oh, all my deals are doing very well, except one deal didn't pay out. They promised to pay out, and they didn't pay out." I said, "Okay, that's fine." And that person was telling, "Oh, this person is not that good because they didn't pay out." I said, "Well, maybe their business plan could have changed, right? Or maybe they didn't expect something that supposed to happen and happened, right?" Then the doctor also made a comment saying that, "Oh, there's another deal. I mean, all my other deals are paying out immediately after I invest." I said, "Well, that they could be faking it." And then the doctor was surprised. "What do you mean they're faking it, right?" So I mean, it's not easy to get a cash flow day one, right? Because if the cash flow day one, then all the institutional money is going to come and grab all this multifamily, right? I mean, who doesn't want 7-8% of return, right? Day one, right? So a lot of deals that we buy need work. It takes some time to stabilize, right? It'll take like 6 months, 8 months, and all that. To really stabilize and pay out returns, right? But sometimes people give returns much quicker, right? And sometimes they overraise and give, and that's why I'm saying that it's not all the time all deals are well, all well organized to give that cash flow day one. You have to do some work to get to that cash flow, right? And usually my investors, I tell them very clearly, it takes 6 months to give me cash flow, and all of them are perfectly fine, right? But the perception of people giving you a cash flow doesn't mean the deal is doing very well. Right? The cash flow can be generated by many ways, right? The pure investment way is the cash flow generated from the asset. Because that's what all of us are taught to. We say we buy a real estate, it's a cash flowing real estate, it's going to give you money, right? That's what all of us were taught to. But some syndicators, they split this cash flow into two, right? They say this asset, this is escrow account, I'm going to pay out from escrow account while the asset's being stabilized. Right. So who's correct, right? So we have to be I mean, so I say a lot of passive investors doesn't know what's happening in the industry. I mean, they are investment that pays out direct from the asset, which is the right way to do it, and the investment that doesn't pay out from the asset, right? So you have to really know the plan and the deal sponsor and all that, right? Because if you overraise and pay, that means you're basically diluting your entire capital.
Yeah, and let's focus on that point. So for example, in our situation, we're here in Canada because of the extremely low rental yields, the low rent to value ratios is one of the main reasons we invest in US multifamily, because of the rental yields are much higher, the rent to value ratios are much higher. So it makes sense for us to buy an asset, putting down conventional 30% down from the borrowing 70% debt. From the rents we collect, we can pay our mortgage payment, taxes and fees, third-party property manager, and still be left over with a surplus to pay our investors. But as you said, in deep value-add projects where the operator, the sponsor needs to use the equity raise for the down payment, for contingency, and for the capital expenditures for renovations, at that time there is no really rental surplus because certain units might not be occupied, so the occupancy might be low. So yeah, there is no really cash flow component for this first period of the deal. But in some cases, what you're saying is that the operator, a sponsor, is able to pay cash flow to the investors, but that cash flow might be coming because they ended up raising more capital for the deal, or some other creative way to have access to more equity to pay their investors.
Yeah, I wouldn't say creative. I think they just, in my mind, is not the right way to do it. They overraise the capital and they pay it out, right? I mean, of course, they don't tell you this is not from the property, but a lot of investors would be happy getting payout, right? If you invest 100,000 today and next month you start getting cash flow, they said, okay, when is my next deal, right? That's the next question. All investors are, tell me when's your next deal, because I'm already getting money. But actually, that money is not really from the property itself, right? Right, so it's from some separate account, right, which is not from the property. The property may need another 6, maybe 1 year to stabilize, to give real cash flow, right? And there are cases where the property didn't even get cash flow, it went down the hill. And what happened is this reserve that these sponsors have been raised to take care of this payment is no more available, right? Because you know you're losing money, right? Every year you're losing money, right? So in that case, you get caught, right? That's where you have to go back to your investors. Actually, we don't have the money anymore.
Okay,
right?
so the advice to the investors, when you're looking at certain returns and certain promised cash flow that are promised by the operator, is to ask the question that where is the cash flow coming from? Is it from the surplus from the rents collected, or is it coming from the raise? Is that a question?
That's a fair question to ask, but no one was going to answer that, right? No capital raiser is going to answer that, right? So no syndicate is going to answer that, right? They say read your PPM, right? So you have to as a passive investor, you have to be really good at reading your PPM and your company agreement. You can't go to a lawyer and can you interpret this company agreement to me? Because lawyers are going to interpret whatever is written. They're just going to tell you what it is. Right. But as an investment expert, we have to know how to read a company agreement. And the problem with this company agreement is just so long and so written in these legal languages. It's very hard to really decipher what is actually written there, right? But if you read it properly in the distribution section of the operating cash flow, they will tell you very clearly where are they getting the money from. Right. And sometimes it's being raised as a capital call reserve, right? Capital call reserve is actually, there's no capital call reserve. Capital call is always the first thing that being paid out of any investment. In case there's a capital call.
Yes.
So let's say you do a $10 million raise, halfway through something happened, I need another 1 more million. And then the next quarter or the next 1 year when the property start cash flowing, we want to service back that 1 million. So there's always a capital call line saying that capital call we always service first. But sometimes what happen is some syndicators, what they do is they raise the capital call reserve and they start paying out as though, hey, I have this money, I'm paying you guys out. But they don't tell you that it's really it's just a over-raised money, right? So the problem I see with that is a lot of passive investors have this high expectation, right? Hey, how come this 5 people is paying out and there's one guy who didn't pay out and there's another guy? So the guy who didn't pay out, he might be a true, genuine real estate guy who is doing a real hard work on turning around a property. But the other 5 guys who's faking it become the heroes. And this one guy who's doing a real stuff, he become the bad guy because he didn't pay out.
Got it. Now, one question here. So again, like the advice to passive investors watching this show, and the goal of our show is for passive investors. So to go and become so sophisticated that they can fully comprehend a subscription agreement or a PPM, to fully understand what the plans of a GP is, if the GP hasn't been totally open about what the plans are, and sometimes those plans do change. Is it good measuring stick or a litmus test preferred returns? Is it fair to say preferred returns are a great way to evaluate if the GP is putting basically their money where their mouth is? Is that a fair
Absolutely. I love preferred returns. So I started my syndication using a profit split, right? So I'm sure you guys are aware, right? In my book I've written this something called profit split.
Please describe it.
There's two types of compensation in the industry. One is where we get a profit split and then we just split 80-20, 70-30 or whatever we get, we say we split. That's where I started. I came from that mentality. I said, hey, alignment of interest between passive investors, right? But what I realized, I also wrote in that book as well, that one of the bad things about profit split is when the deal goes down the drain, everybody goes down together, right? Right. So now, because the passive investors who are supposed to get at least 6-7% return may not get anything, right? Because now they go together with the sponsor, right? And so it doesn't work very well on a downturn. And during COVID, that's what happened for a lot of people who does profit split. A lot of passive investors didn't get paid, and a lot of sponsors just, okay, I'm not going to pay out, right? When they say no payout, they say both in the same boat, right? Nobody gets paid out, right? So the other structure that I mentioned in the book is called pref return, which is a waterfall structure, right? And the waterfall structure gave an investor a base return, right? 6, 7, 8% base return, which is the first return that we have to give it to passive investors. Then only after that, the GP start taking money of it, right? So past 3 deals that I'm doing, I've moved to pref return structure, because I think there's a lot more advantages for passive investors, and it's a lot more powerful for syndicators, because syndicators now are motivated to do more better on the back end.
Yeah.
Right. Otherwise, syndicators are not very motivated to do more on the back end or to push the performance. If I'm a 80-20, I mean, as I said, I have a lot of deals when I'm doing 80-20, and I always think about even my own thought process. 80-20, okay, so what? If it doesn't work, it doesn't work, right? Both of us are the same boat, I can't. So if I look at a passive investor, now they are like in a disadvantage, right?
Yes.
For me, during COVID, I can stop payment and nobody's going to say there's nothing accruing, right? But on a pref, it
Yes.
accrues, right? Assuming it's a cumulative pref, right?
Yes.
So
Yes.
pref accrues. So the passive investors are better protected. So I wouldn't even say alignment of interest. I would have said we were putting passive investor interest first.
Of course.
Then the sponsors are taking money, right? So
Of course.
yeah, so I think pref is very, very powerful. And I think one thing I wrote in the book, which I think, if I write a second revision, I need to correct that, is basically, I said pref return is filled with fees, right? I think if I remember correctly, it's filled with fees, whereas 80-20 is less fees. But it's actually, as I said, I learned a lot even after writing the book, right? I realized that even with 80-20, you can put whatever fees you want, right? You can put all kind of fees. If fees are fees, I mean, you as a passive investor need to see whether it's reasonable for a sponsor to take or not. But the structure of how the passive investors are being compensated is very, very key, right? So for me, what I see is pref return is a lot more powerful right now. And I also realize 80-20 people are manipulating 80-20 or profit split a lot. A lot of manipulation happened between syndicators and sponsors. So let me give you some examples of manipulations, right? So people said, I mean, not say people said, I like to use the word people, but
Sure.
in general, right? A lot of passive investors or sponsors said, hey, I'm doing 80-20 profit split, or I'm doing 70-30, I'm doing 90-10. But there can be three ways how the split happens. First is, they can say this split is a return of capital, right? I mean, they really won't talk about a return of capital. And what happened, return of capital or return on capital? Return on capital is basically true profit, right? You're getting a true profit on top of your whatever money that you're investing. If you're putting 100,000, if you get 1,000, is 1% of that 100,000. So your 100,000 is always kept, right? So that's called return on your capital, right? The 1% is on top of 100,000. But if you call return of capital, that $1,000 could be part of that 100,000. So you basically, once I distribute the 1,000, your remaining capital is 99,000.
Which is,
so if you do it, which if you do that for 5 years, if you do a return of capital for 5 years, let's say if I'm giving 10,000 per year,
yes,
right? Let's say I'm put 100,000, I'm paying you 10,000, 10,000, 10,000. And the way it's being structured is return of capital, right? So how much you made for the past 5 years? That's a quiz for both of you.
You have made zero.
Yeah, absolutely. You didn't make any money for past 5 years because
yeah.
you have been getting back your own money. It's actually a loan,
Yes.
right? I mean, only on a loan you get back your capital, right? So
Yes.
it's actually a free ride loan for sponsors, right? So, but on top of the loan, you are basically, I mean, yeah, of course, they said at the sale, you're going to get back your money, right? Because they said, I'm giving back all your capital, and at the sale, I'm going to do an 80-20 profit split. But the whole risk for passive investors has been put at the sale, which is 5 years down the road.
Yeah.
Right. So basically, it's a huge risk for passive investors. They have what the syndicators have done when they do a return of capital structure. They have taken this low risk multifamily investment or any commercial investment. Multifamily is very, very low risk investment, right? If you might buy it right, it's low risk. But because they have done this as a return of capital, they have just by changing one word in the PPM, they have made it a high risk for passive investors. It's a super high risk. Nobody knows what's going to happen in the next five years. If I'm getting cash flow today, that is low risk for me, right? Because I'm already making profit, right? But if the sponsor structure as return of capital, I'm not making any money for next 5 years, right? How if the market crash in the next in 5 years? That means you didn't make any money and you crash at the end.
Yes.
Right. And what has happened in that case, if you do your math correctly, let's say 80-20 return of capital, it's actually after 5 years, it becomes actually a 60-40 or 70-30 profit split. Because the amount of money being returned, your capital is being diluted, right? Let's say you have 100,000. Let's say after 5 years, you paid 10,000, so your remaining capital is only 50,000, correct? So at the end, when they split, They said, I'm going to return back your capital. So they're going to only give you back 50,000, but now the pie is bigger on the back end. Right? So it's no more 80-20, it becomes like 60-40 or 70-30.
But not all operators do that. Some operators, even though they're doing return of capital, your investment doesn't get diluted. It stays.
Very, very few operators do this. Very, very few.
Okay.
Right? So that's the good part of it. But I know a big group of operators doing it.
That do it. Okay.
That do it.
Yeah, it usually goes by group, right? Some groups do it. It's not like you can't find the normal professional operators doing it because everybody will see it. But the problem is you get blindsided when you're in a group.
Got it.
So everybody thinks the same.
Yes.
Oh, this group, everybody is the same. This is how the structure is.
Yes.
They get blindsided.
Two other points that I see kind of in the positive for return of capital is one is inflation. So if you if you invested $100,000 case study into a syndication and you're getting a return of capital $10,000 a year after 5 years, because you got that return of capital back, it reduces the inflation. Now that 100,000, if it was in the deal, would have if it wasn't in your hands, it would have been a lesser amount worth because of inflation. Right. And then the other situation is in our case, because our investors there's cross-border taxation items, it makes a lot of sense for the amount that's coming back to them not to be cash flow and be return of capital, because the tax is it works better for cross-border taxation items for our investors because they don't have to they still have to file for US taxes, but they put that they didn't have an income on that particular investment.
Yeah, well, I mean, you want to check that with the CPA, because I've talked to the CPA. Even you do return of capital or return on capital, on a tax world, is always considered as return of capital.
On a tax.
In the tax world. Yeah, there's two worlds whenever we invest. One is called the investment world, and the other one is tax world. In the tax world, it's always been return of capital, the way they treat any distribution, right? Only on the investment side, when you look at investment risk, right, this becomes very important. Right, because it's more of an investment risk. I mean, tax world, it's completely different. Right? And I talked to my CPA. I said, "Hey, I see some syndicators because it's an awesome compensation structure for syndicator. I would love to do that." Right. So, but I went and say, "Hey, is this correct?" I mean, because the people who does this, they claim that it's better for taxation because now you're getting return of capital. And you don't have to pay tax on it, right? But then I went to CPA. They say, well, we treat all of it as a return of capital.
In the tax world, right?
Yeah, in the tax world. So you want to talk to a CPA and confirm that and see, and then make sure that that's correct. But I talked to many CPAs, and they all told the same thing. And all my structures are written on capital. And when I look at my K1, they treat it as I'm giving back the capital, right? So
and you structure all your deals as return on capital.
Yeah. As I said, very few people do return off capital. 95% of the people there do a return on capital, because that's the right way. I mean, from my mind, is the right way to do it, because you are basically giving through profit. When I talk about I'm giving you 10% cash on cash, right? You're talking about cash on cash, right? Yes. I give you cash 100,000, I give you another 10,000. It's a cash on cash of 10%.
Yeah.
You can't say I'm giving you 100,000 and you give me back my 10,000. I can't say I'm giving you cash on cash. Right, you have to say that I got back my cash, right? So it's a different measurement, right? And cash on cash is very standard in an investment term, right? So, you want to check on that and all that. I mean, inflation, it's up to interpretation. I mean, now is the inflation thing, right? But inflation didn't exist, not say it didn't exist, it was very, very small. Now people are talking about it,
right?
But for me, it's all about risk. When I'm investing my money into someone, into any deals, even stock market, what is the risk right now? I would say right now, stock market is super high because it went up so high for past 10 years, right? The potential of it going up higher is low compared to potential of it going down, right? It's more chance of going down. So the risk is high for it to go up, right? Right? It's supposed to come down. I mean, same thing with real estate. The risk is higher for it to come down because we have seen so much upswing, right? I mean, except for the COVID reset that we have. A lot of people got burned during COVID and some of them are already out, right? So that could be considered a new market cycle. But I think it's all about risk. What risk are we investing, right? And what is the cash flow that we are talking about? When I talk about 10% cash flow from a sponsor who has done this many times, right? Or let's say from a 10% from a guy who's doing it first time, is much, much high risk compared to a 6% cash flow from a guy I've done this for 10, 20 times. Because the guys who have done 10, 20 times, he can confidently tell, I can tell you 6%. The guy who are so new, the risk of his projection become true is high because he's the first time you're doing. The numbers looks big, but it's all on Excel spreadsheet. Who cares?
Yes, they're all projections.
All projections. The rubber need to meet the road.
For sure. And James, I wanted to talk about how,
Yeah.
and very good points. I wanted to talk about how your business is vertically integrated. Talk to us about the challenges that exist with this business model, because I know, like us at CPI here, we partner with active operators in the US to bring us opportunities to our investors. But in your case, as you're mentioning, you are the operator, but you manage the properties in-house as well. So maybe you could talk to us more about this topic, please.
Yeah, absolutely. So yeah, we are vertically integrated operators. So we have our own property management company where we have like 45 people working for us.
45?
Okay.
Yeah, we have like 45. I have like 8 corporate people working for me, and the rest are all in the property, right? So we like to have vertical integration because we do a lot of difficult projects. We do a lot of value add, deep value add, and all that, which needs, I can't give it to third-party property management because they'll mess it up, right? So not many people are skilled and turning around property, turning around demographic, turning around income. It's a lot of micromanagement that need to happen.
Right.
And that's why we have an office here in Austin, Texas. We have all our corporate people there. We have meetings, and we want to make sure that we have that control of our investors' money. We want to have that control A to Z because we are very serious about our investors' money, and we want to make sure that we're able to deliver what we said we want to deliver.
And would you say, like, if you were going to give an advice to a smaller real estate private equity firm or people that are looking to kind of be more actively involved and getting involved in larger multifamily assets on the active side, would you suggest being the operator and then a step farther to also start an operational kind of property management firm alongside their syndication or private equity firm? Because a lot of feedback we get from operators, a lot of times groups partner with operators, and then the step farther is to have the management. It's a lot of management, it's a lot of work. So talk to us about.
It's a lot of work. Yeah, a lot of people don't want to do work, right? So
a lot of work.
Well, I mean, it is a lot of work. Yeah, absolutely. I mean, so I wouldn't say I would recommend everyone to do it. I mean, you need to have the skill and the character and the gut to do it, right? Otherwise, you just give it to third-party property management because they are professionally managed assets, right? Which is definitely a good thing too. But as I said, we do this because we want to be in control of the turnarounds that we do.
Yes,
right?
and another thing is the regions. It limits you to be in the region you are because you need to have an infrastructure in place. You need to have an asset manager, the property manager, all the employees in-house. So you can't just go, if you're focused in Texas, you can't just show up in Arizona and do everything, rinse and repeat your process there. Is that true?
Yeah, well, that's true. So that's why we are focused a lot in Austin and San Antonio. Right. And I think, focusing on a region is good because nowadays market is so hot, right? I mean, if you go around everywhere in the country, the brokers will be looking, who is this guy? This is a new guy coming to my city. I can bully him, right? So a lot of times when a new guy show up in a new city, he'll get the worst deal out of that city because all the locals don't want to buy. Right. So the locals like us who are specialized in certain region, we know all the brokers very well. We have lunch with them, we talk to them. So we get some of the best deals in that region.
You got the relationships established.
Yeah, relationship and all that. And the good thing is I'm already in Texas, so I don't have to go anywhere. Right? If I am in some place where it doesn't go, let's say I'm in New York, I'm trying to grow this business. Of course, I'm going to look at where it makes sense. Right? Maybe I buy one in Arizona, maybe I buy in Florida one, and Texas one. But as I said, most of the time, these operators who doesn't have a good presence in that certain region, it's not going to get the best deal. I mean, it makes sense, right? I mean, brokers, they're gonna find who's the least sophisticated in that market. right?
it's
And throw
really
them the worst deals to them, right? So
Yes.
right. It's definitely a relationship-based.
it's very, very relationship basic. But you're right. Now I cannot go everywhere, right? But I'm okay with that because we are already in a good market, and we want to focus a lot on our backyard, right? But as I said, if I'm somewhere else, I might be thinking differently.
Right.
But
Yeah, that makes sense.
yeah.
I'm curious, James. What is your prediction of the market short term in the next 12 months, and then possibly long term in the next 5 years?
I think for next 2 years, there's not going to be any change. I mean, not say any change. It's going to be multifamily prices are going to keep on going up.
In the next 2
because
years.
a single family is too expensive right now, right? For single family, right? So that's my projection for next 2 years. Multifamily is going to go up. In fact, we are doing a lot more build to rent, which is single family rentals, which is run as a multifamily. We call it as horizontal rental. So we are getting into that space as well. So that's going to be a very big asset class moving forward as well. It's going to be similar to multifamily, but it's going to be a bit more niche because a lot of people who are in this, top cities like Austin, Charlotte, the big cities that Arizona, Phoenix, and all that, houses are so expensive, and people are paid so much money, they don't mind renting, right? They can't buy houses. Sometimes they move from California or somewhere, they want to stay temporarily. They don't mind staying in a nice single family rental houses, right? So a lot of
August is
built to rent.
has his eye on the built to rent.
So built to rent is becoming more popular, and we're going to focus a lot more on that. But we still focus on multifamily. Multifamily is our bread and butter, and we love it, and we do that as well. It's not going to go anywhere. I mean, built to rent is new asset class. It has a good projection moving forward, but still got a lot of things to be tested and tried, right? But multifamily, always there's always demand for it.
Yes. So next 12 to 24 months, multifamily is going to stay on the same trajectory as on. And then talk to us about what is your prediction for the next?
I think after that, what's going to happen? Even I think end of next year, once the tapering by the Fed stop, then the interest rate is going to keep on going up, right? And at some point, it's going to, cap rate compression is going to stop, right? It's going to compress. I mean, multifamily is going to keep on compressing for next 6 to 12 months. And after that, it's going to stop already. I mean, it's going to be so expensive to buy multifamily. Nobody can't buy anymore, right? But after that, once interest rates start going up, then, it's going to plateau at that time.
Got it. And the interest rate, I mean, that's the most common way to balance inflation is by increasing the interest rate. So it's just a matter of time before the interest rates get hiked. So it's something that
correct. Interest rate and also the supply, right?
Yeah.
Supply of the apartments. Like we see, like last year, because of lumber price was so high and COVID was so high, a lot of developers stopped building. Right, but now everybody is starting, right? In fact, I'm building, like as I said, I'm building 700 units right now. I'm starting to build. Next 2 years, the supply will start to come, right? However, keep in mind, real estate is so local, right? I mean, in Texas, where people are moving in, I think it's going to keep on growing, right? In California and maybe the coastal cities, 2 things happen, right? One is they know that during bad times, they're going to get a lot more rent control happening. Right, and people start moving out from that states, coming to Texas, Florida, Atlanta, Georgia, Phoenix. And people start, that's why all these places are booming because people are moving in. So I think these few cities that I mentioned, few states that I mentioned, is going to keep on growing no matter what. Right, but all the other coastal is going to be a problem. I'm getting a lot of calls from New York right now to buy my deals. So many calls right now.
Oh, really?
Almost every day I get called, hey, do you want to sell your deal? I say, wow, New York guys never call us, right? But now they start calling because they know it's more safer to invest in Texas compared to investing in New York, right? I mean, when when things go bad, I mean, you see what happened, right? I mean, there's so much of rent control. People are leaving the states. Just because of migration is just going to keep on going up.
Job growth as well. You have a lot of large companies moving to
Absolutely.
Texas. I mean, it's just insane. How many companies are moving there. So as jobs move to a region, then the people flow, right? So I definitely totally agree.
Job region, and also the other factor that we all don't forget is US is still the best the best place to invest, the best place to get yield across the globe, right? Nobody's going to invest in China, right? Because nobody trusts they will do what's correct. Nobody's going to invest in Europe because it's all negative interest rate. I'm not sure about Canada, so I really can't talk to it, right? But I think a lot of countries doesn't have that yield. You can't get that yield like what you're getting in the US.
Yeah.
Right. So a lot of money is going to flow from overseas to the US. So that could be the what you call the anomaly, compared to whatever happens to the interest rate or what, money keep on going to flow because
And people too. America has the brand is Hollywood. People all over the world have a little bit of American inside them. They want to move there as
they
well.
want to move there.
Not only the interstate migration, but you also have actual immigration.
People immigration. Yeah, that's true. That's true. So that could be the wild card, I would say, the money inflowing to the US just because of the interest rate and the trust in the money, right? I mean, people know that if you invest in it, it's not going to go anywhere, right? Compared to other countries, I mean, like China, you wouldn't know whether money is going to be there or not, right? So much of manipulation. So
corruption and what have you too, right?
Yeah, correct.
That's the biggest issue. Great. Yeah, before we go to the next segment of our show here, maybe
I would love to ask James, what would
Sure.
be your, we would love for you to just share your best advice to someone that's looking to start passively investing in real estate.
Okay. I would say the best advice is choose a few select deal sponsors and stick with them. They can make you very rich.
Okay,
Nice
advice. Okay,
Great.
awesome.
I would call it as the alpha syndicators, right? Syndicators who does things differently from everyone else.
Nice.
Right. I mean, there's many syndicators out there who just buy a normal apartment complex, a normal return, a normal business plan. But there's a lot of syndicators out there, not say a lot, there's very few syndicators out there who does things differently, right? Either they find deals off market, or they like to do this crazy new, office to multifamily conversion, hotel to multifamily. These are guys who are like specialists in real estate. Look for them, tag along with them, and build relationship with them.
Yes.
They can make you twice as rich faster than normal investment.
Yes. And I believe I was seeing some data is that the passive investors that are very active in passively investing, in average, they invest with 3 different operators or 3 different.
Oh, really? That's good. I never seen that data, but that's the reason. That's what I was talking about. Select a few.
Yes.
Yeah.
I mean, as I say, you wouldn't know this in the first few years of investing because you think everything's the same.
Right. You learn as you go, and then you choose your people.
After 3 years, you realize, oh, not all the guys are the same.
Yes.
Let me go with a few 2 or 3 guys, and I focus on them.
Yes.
Right? So that's the advice that I want to say. Whatever I'm telling you right now, you're going to cut short your 3 years passive investment. Just go to the best, focus on them, build a relationship with them.
Take Steve's advice today, so you don't have to do it 3 years down the road.
Yes.
Yeah, I know.
And funny enough, just for me to share a quick story here, is a lot of time we interview sponsors and operators and syndicators on our show, and a lot of times, even though I'm a GP myself, I think about, I'm like, hey, would I invest with this operator? So a lot of time I have my own kind of set of reasoning of what operator I would invest in. Some of them is because of more emotional level, and some of them because their group is very analytical. So I myself kind of would diversify my passive investments amongst different operators. So it's cool that you mentioned the same thing.
Yeah, very good advice.
Yes.
James, we're going to just finish our show up with our 10 championship rounds to financial freedom. It's our next segment.
Absolutely, let's do it.
I love it. So I'm going to ask you questions, and then whatever comes top of mind. So here we go. Number 1 question. Who is the most influential person in your life?
My wife.
Very nice. Awesome.
It's a very common answer.
Yeah.
Very common answer. Yeah.
Yeah,
The boss.
That's awesome. Next question. What is the number 1 book you'd recommend?
Apart from my book, right? Of course, right? So I would say Think and Grow Rich.
Oh, nice.
Napoleon Hill.
Napoleon Hill. Yeah, that would be the one book if you ask me one book. But if you want another book called Magic of Thinking Big, which is not a very well-known book, but that's a really good book, Magic of Thinking Big by David Schwartz.
Thinking Big. I've never heard that one, so I'm writing it down. There we go. Thank you for that.
So.
If you had the opportunity to travel back in time, what advice would you give your younger self?
Nothing. Yeah, there's no hindsight 2020. I would have done this better or what, right? So I would have just said, I mean, all experience are good, right? If my younger time didn't do what I was doing, I mean, I wouldn't have been here, right? So I'm in a good position. So I'm happy with my younger self.
Probably move to the US. Don't move to Canada because the rental yields are too low. That's the advice you would have given.
Yes,
So forget about the PR. Move to the US. Get the green card.
Canada.
Get the green card. Yeah.
That's so true. Now I'm curious, what's the best investment you've ever made?
On my education, of course. Yeah. So I have mentors as well. And my mentors, I mean, they give me bits and pieces which can take you 2x, 3x of, shortening your learning curve.
Awesome. What's the worst investment you've ever made?
Worst investment is, of course, not starting early enough. I don't know whether it's an investment or not, but I should have started early, right? So, yeah, I don't know whether it's an investment, but I would say that's, yeah.
Yeah, that'll bring value to people. So how much would you need in the bank to retire today? What's your number?
I don't need a lot. I mean, to retire, probably need like, a few $1 million, right? Anything above $2-3 million doesn't matter in life anymore. You still go to the same grocery shop. Your car still have four tires. You still live in a house with a roof. You still have a family, right? So nothing changes beyond $2-3 million, right? So, yeah, a few $1 million is good.
Awesome. Awesome. Now, if you could have dinner with someone dead or alive, who would it be?
I would say Jim Rohn.
Okay.
Yeah, Jim Rohn would be a really good guy.
Awesome. Okay. Now, if you weren't doing what you're doing today, what would you be doing now?
Engineering, I guess.
My dad was an electrical engineer.
Yeah. Engineering. So a lot of fun. Yeah. It just become monotonous. I mean, real estate's a lot more creative juice, right? You need to really think of.
Totally.
Yeah.
Now, James, book smarts or street smarts?
Street smart.
Really? That's come from a guy who's an academic and an author. So
Yeah. Wow. Street smart is better.
Okay. Last question. If you had $1 million cash and you had to make one investment today, what would it be?
Into my ground up construction.
There you go.
Nice.
That's a wrap.
Awesome. Great. That was great.
So much, James.
Thanks, James. Thank you so much for taking the time. We know you from your busy schedule. We really we're excited to have you on our show. We're sure that this show is going to bring great value to our audience. So really appreciate you taking the time.
Absolutely happy to be here.
Thank you.
Thank you so much.
Thank you.